Ladies and gentlemen, I'm going to start a 6-segment presentation here today. It's designed to show how the United States, the Internal Revenue Service, and the Treasury Department have finally really caught up to the rest of the world. After years and years and years of this global world growing, the United States has now become fully aware of the fact that there are all kinds of offshore transactions that might be taxable, that aren't being taxed, that maybe even in this new internet age, there's a new type of tax that's needed because it's so easy to change the place of doing business and everything. This is coming on stream very fast. What I'm going to tell people about in this 6-segment presentation are all of the new laws that have just come in, boom, 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 like that. 1, 2, 3. 3 important new laws covering year 2011, 2012, and 2013 that show you how the reporting, information reporting now required of the United States is going to essentially make it so that every foreign financial asset and every United States financial asset owned by any American person is going to be disclosed wherever it may be. In addition to that, while tangible assets such as real estate, jewelry, art, while it hasn't gotten to the stage of taxing those tangible assets, it has gotten to the stage that if you sell one of those tangible assets and you make a gain on it and you don't report the gain, then you're going to have big trouble. And when you do report the gain, someone is going to ask, where did all the money come to buy the asset in the first place? So let me just give you the introduction right now to where we're going. Right now, the United States has a voluntary compliance tax system. It works for the most part very, very well. However, it hasn't worked when it comes to outside of the United States. And there's been laws for a long time on the books where you had to report your foreign bank accounts. Any foreign bank account an American had control over that was of a certain amount had to be reported. The failure to report these foreign bank accounts by an American and the failure to pay taxes on the income on these foreign bank accounts could be disastrous. The penalties for not filing these documents was every single year the penalty could be 50% of the highest balance in your foreign bank deposits. Well, that still continues on, that penalty. That's the one that stays out there that scares everyone into order and into compliance. The facing of a total wipeout, you could have a $4 million bank account, keep that same bank account in a foreign bank for 8 years, never report the income that's earned on it, and pay $2 million a year for 8 years, have a $16 million penalty on the $4 million bank account. So that's how punishing this thing gets. So with that F-bar in mind, that it's always been there, 3 new laws have come into place. The first one is what they call FATCA, F-A-T-C-A. And we're going to focus on this chart now. The chart is going to show you in red what the new laws are. We're going to focus on FATCA. That's up here. In your U.S. voluntary compliance corner, all right, of all the things you've got to file and tell about yourself, it's been added that you now have to disclose every foreign financial asset that you have ownership in over a certain de minimis amount. That's 2011. The next one, 2012, is an amnesty that's been offered. So for all of the people that may violate all of these new rules and have violated rules in the past, there's now an open-ended amnesty program on how to pay your taxes, pay a penalty, avoid criminal penalties, and move on with your life. We're going to study that in full. The final thing we're going to study is the foreign financial institution accounting that now is going to go on. That means any American who opens a bank account in a foreign bank is going to have to disclose to that foreign bank that they are Americans. If they don't, and that foreign bank cannot account for them, then any payments that their accounts receive from American sources, any dividend payments, capital gain payments from U.S. sources, are immediately 30% is going to be taken from that, paid as a tax to the United States on that account, because it might be a U.S. account. And if the foreign financial institution does not do it, they are going to be responsible for that 30% tax. So we're going to study all of that. It's going to take, this was introduction, we're going to take 5 different segments. We're going to has one segment for the amnesty, one segment for the FATCA, the asset disclosure, one segment, 2 segments for the foreign financial institution reporting, and then we'll wrap it up and put it all together to show just what this chart shows between the reporting of the United States financial institutions and all employers and all payors of any kind of investment income, between the F-bars that can wipe you out and the voluntary compliance that's needed with all of the returns and information returns that must be filed. Now together with the foreign financial asset disclosure and together with the foreign banks withholding your taxes if you have a foreign account and get paid with U.S. source income, and the amnesty, it's a new ball game.